Now we are going to see a pattern which is probably one of the most famous patterns and very well known patterns, which is called a rounding top or a rounding bottom or a saucer pattern or a bowl pattern or a cup pattern, whatever name you want to give. Let's look at the diagram first and then it would be more familiar for most of us. Now, as you can see here, this pattern is bound by one trend line. Now it could be a rounding bottom. This one is rounding bottom, as you can see here. There's no straight trend line, and it starts with a curve. The prices are decreasing, and you can form a curve, bottoming out curve here. So as you can see, the prices are not reversing as per a straight line. There is no support line, but it's more of a curve, support curve. That's called a cup or bowl, and this resistance line is called as a saucer. Now what we see at the lower side or rounding bottom could also very well be a rounding top on the upper side. So this resistance line would be a support line. So it would be just as a mirror image. We'll talk about one of them and the other one is just self-explanatory. So we have this rounding bottom, and then of course this rounding bottom is more common than rounding top. So it makes sense to look at this pattern rather than rounding top, but it's very much the same. It's just the reversal of rounding bottom. The longer the pattern, the better. It usually happens over multiple weeks or even months. So that gives us more conviction. The prices are gradually reversing. So it is not evident when the pattern is being formed, right? We get confirmation about pattern only when we are in this region, right? We've crossed this lip region. So we can see the prices kind of getting supported by this curve or this bowl or a cup. Then this is the consolidation area or lip area. It's again touching the resistance line at the top. The prices are consolidating here and then there is a drop. And this is the handle part, right? The handle of the cup. Right? So if you imagine a cup, this is the cup, this is the lip, right? Lip region. So this is my lip and this is a cross section. And now I can draw a cup probably here. I'm not sure about my drawing with this, but I guess we can take it as a cup approximately. Right, so this rounding side of the cup is this rounded bottom. This particular area of the cup is my lip here, and this particular area is my handle. And of course, it's an approximation. It's a fancy name given to a pattern, so we can't see the exact thing. But after the handle, the breakout will happen in case of rounding bottom on the upper side. So after the handle is formed, then can we be sure that the pattern has formed, the rounding bottom pattern has been formed, and then we can enter into position. But our entry point should be above this resistance level. Our entry point should be above this resistance level with certain confirmation or some conviction here. So if this particular lip and entry form my top resistance, right? Lip point and entry point. Rather, it's more of a lip actually, because entry could be this. Before this entry, the prices could be coming somewhere like this. So my lip is an important formation. The point where the region where the prices start reversing, right? Consolidating and reversing, that could give me my new support level after breakout. And only when prices have crossed this after the handle formation can I say that there is a breakout, and after obviously adding some filters. So once the breakout happens, it is going to break out upwards. So it can break out like this directly, or it could reverse temporarily and have a throwback like this. Either of them is very possible, very much possible. The handle could also have an extension. So there is a possibility that the prices could go on decreasing after handle. So prices may not ever reach this breakout region in this region, or they may not ever experience throwback, but the prices continue to drop down after handle. It is very much possible. We've seen this happen, but it's not too many cases. And then that's why we have to wait till the breakout happens. Again, very popular, but its profitability is questionable. Its profitability is not very high as such. However, it is well known among the investor and even non-investor public. If this pattern occurs over a shorter period of time, right, over let's say a couple of days, then it's called as a scallop. SCALLOP, scallop. It is the same pattern but over a shorter period of time, and that's the only difference. Now this is my rounding pattern, rounding bottom. Another pattern that I'm going to see is head and shoulders. Again, one of the very famous, in fact one of the, could be called as the most famous pattern, and also very statistically significant. In fact, it was one of the patterns which has been proven statistically significant, statistically profitable, right? Let's have a look at this diagram. So we can have a head and shoulders at the top or head and shoulders bottom. I guess after looking at the diagrams, the name's pretty evident. Head and shoulders happen at the top when the pattern is formed above this support line. In case of head and shoulders bottom, the pattern is formed below this resistance line. But again, it's very reciprocal of each other. So what we have is three peaks, the middle peak being at a higher level than the left and right peaks. This is these two peaks are called left shoulder and right shoulder, and head is usually at a higher level than the shoulders. We might also have difference in heights for left shoulders and right shoulders. Right shoulder could be slightly lower. Usually volume is highest here. The reason being, entry is usually from bottom, right? If we look at here, entry is usually from bottom, opposite side. So there is a trend, a momentum kind of that continues when the prices enter this left shoulder region. Prices are very high, especially the bullish forces are very high. After that they reverse and prices, the volumes start declining. They're usually lowest here at this region, and after the third shoulder has been formed, then we can be sure that the pattern is evident, so we can have some eviction around the pattern. Now at this point, somewhere around this point, when the second shoulder or the right shoulder is formed, then we can have some trades going in. We can have some traders which are more aggressive, higher risk taking ability, so they could enter at this position and profit. But if they exit somewhere here, right, in this region, or rather in this region, when prices are coming up, then that could be a whipsaw, because their conviction, even though their trade prediction was right, they exited prematurely and hence they got a loss, rather than waiting till the end and waiting for the pattern to complete and exit from the trade at a profitable position. So this is the head and shoulders pattern. Usually, it is preceded by uptrend, but it's not a necessity. It can come from anywhere. The performance rank, as per the Bulkovsky study, is 1. So that is the highest rank. So it is very profitable most of the times. It gives satisfactory or even good results from the in terms of the pattern being recognized and the trader being able to profit from it. We can also have two heads, right? So instead of second shoulder tapering off from here, we can have second shoulder coming up all the way till here and then reversing, or we can have more than two shoulders, more than one shoulder on one side and one shoulder on the other side, or we can have two shoulders on any of the sides. They are called complex head and shoulder patterns, very likely but very rare. And one of the reasons why we cannot mechanized and computerize these pattern recognition techniques is because of such variation. There is no single rule, or there is no specific pattern as a specific replica that would be seen. This particular support line in case of head and shoulder top pattern, or the resistance line in case of head and shoulder bottom pattern, is called as a neckline. So this is head, shoulder, shoulder and neck. So just a name that you can keep in mind. Otherwise, this line itself does not provide much information except when the breakout happens beyond this point. Now, most of the times we have to wait till the breakout happens, because without the breakout, it could be an ascending triangle, it could be a diamond formation, it could be any other pattern. So until the breakout happens and this support level is breached, we cannot be sure that this is a head and shoulder pattern. So it will always be on the opposite side. The head and shoulder top would be always breaking out on the lower side, but we can only be sure after this breakout has happened. Again, we have seen there have been cases where the prices have reversed prematurely. So we have to be sure and we have to be patient with the pattern. Once the breakout happens, the profitability or the performance of this pattern is very high. The target prices are pretty accurate in case of this formation. The target price is calculated as this distance, right, from neckline to this top head, this distance, and projected below it. So if this is 50 and the head is the price at head is 60, then I can estimate my downtrend pullback to continue till 50 minus 10, right? That's the distance from 50 to 60. 50 minus 10, that is till the level of 40. So how much ever is the height of the head could be the height of the breakout or the height of the pullback. And after this point, we can look for another pattern or we can simply close the trade with the close order. Obviously, it has to be slightly above because it's not an exact point, it's a zone. Keep that in mind, we can protect the profits as well. Now, these are some of the long-term patterns that we saw. Now we'll look at next set of patterns which are called short-term patterns. Now we will look at the graphs directly, but before the graphs and examples and looking at the patterns, we'll first go through some of the basics and understand what are short-term patterns. So when we mean short-term, it doesn't necessarily mean that it's for a couple of minutes or a couple of hours. It basically means that this pattern takes over a couple of bar charts, a couple of bars, and it could be 2, 3, 4, 5 bars, and that's it. Now bars could be for hourly trade or for daily trade. That's or it could be trade by trade data as well. And short-term pattern would include only 4, 5 bars taking together. The bar themselves could be for hourly data or for daily data. So that is one point that we have to note. Another point that we have to note is usually for most successful short-term patterns, entry signals are closed either near the close of the same day or opening of the next day, right? So they have to be acted very, very quickly, and it's very less time before we realize a pattern has formed and we have to make an entry and also an exit, right? Compare that with our previous patterns like rounded bottom or head and shoulders. They take place over a couple of weeks or even months. So there is plenty of time to enter and exit from this pattern. But in terms of short-term patterns, it has to happen within a day or sometimes even within some hours. So the entry and exit, it's a really tricky part to manage that. In fact, we can use high frequency data as well to work with this high to profit from the short-term pattern. Also, another point that we have to note is reversal short-term patterns should only be considered along with some support level and a trend line. And that's nothing new that we've seen. The only difference being in terms of short-term pattern, the support and reversal or consolidation happens, the cluster happens over a very short period of time. So it becomes difficult to predict the support levels and resistance level. Usually short-term patterns are reversal patterns, but there are some continuation patterns as well. We'll look at the patterns, which of them are reversal patterns, which of them are continuation patterns. In the previous patterns that we saw, they were neither reversal or continuation. The breakout could have happened in either direction. Usually in case of cup and handle, the breakout happen, or rounding bottom rather, the breakout would happen on the lower side irrespective of the entry. So it was neither a reversal pattern nor a continuation pattern. It depends on what kind of pattern it is. Right? Where all it determines is where the breakout is going to happen. That determines where what kind of pattern it is. So few points to consider or few variables to consider in terms of short-term patterns is the more complex the pattern, less frequency or less frequently it is going to happen. Nothing difficult, kind of simple logic, a common understanding. Another point is relationship between bars in a pattern need not be just a matter of position of high, low, open and close, but also like it doesn't have to be an exact point, but also a proportional point. So we know a bar, just for our understanding, we'll highlight it here. So if this is a bar, how to read it is left point, this particular dash small line is my open price, this one is my close price, this one is the day high, this one is the day low. So the length of the bar is distance between day high and day low, and somewhere in between are going to be my open and close prices. It opened on a highest level and that was my day high, then the open price would be somewhere here. If it closed at the lowest level, then my close would be somewhere here, but my open and close cannot be outside this range. So that is something we have to keep in mind. The important point in terms of short-term patterns is in kind of these patterns, these points not be exact points but could be proportion, like 33% of previous day's range, trading range. So let's say trading range is the distance between high point and low point. Next day's bar could be 33% length of the previous bar. That way the short-term patterns can work on proportions as well. Second is the patterns may be split between two time periods. So one pattern would appear now, there would be some trading happening, and the other pattern may happen sometime in future. So they're split between time periods, but they're still linked. They're still a reciprocal of or still connection of each other, which makes it even more difficult, right? How many trading periods should occur between them is really inconsistent or really difficult to predict, or even in some cases the entry could be delayed by some predetermined time. For example, if in an hourly chart one of the patterns is realized in the first hour of trading day, then the entry could happen at, let's say, t plus 2 or t plus 3, 2 hours or 3 hours from the time at which this pattern was recognized. So that entry could be at some point in future. Another point is the patterns may be impacted by some other market altogether. For example, derivatives market or bond market could impact the stock market and vice versa. So keeping everything this together, it's very, very difficult, and these profiting from these patterns is very, very complex. So what differentiates between winners and losers is experience. More experienced trader will be more likely to make profit, and the more experience will be gained by making more losses, more trade. So it's like a vicious circle. It's like a self-fulfilling prophecy. So keeping these points in mind, we can move to our for pattern formation. Again, opening price is usually very volatile range. Very opening time is also very volatile period of the day or of the trading window. So a lot of traders usually prefer to avoid it, and we often see gaps in the opening ranges. And similarly for closing price. However, closing price is taken more as a confirmation price because it's a final price for the day. It's like a summary for day's activity. That's for two reasons. One is a lot of traders or derivatives traders more often have to close their positions, right? Margin traders have to close their position at the end of the day. So they have to arrange or they have to arrive at a confirmed price at the end of the day. That's why the closing price becomes more pivotal point. It also becomes a signal for next day's trades, right? If closing in this case of bar, open could be anywhere. If close is near day's low, that could probably give me over the short term that this signals that the prices are decreasing. So next day I cannot expect opening to be somewhere outside last trading day's window, right? Somewhere here. It could be somewhere within this range, open to close, or it could be even further. There could be gap down, right? And the downtrend would continue from there for the next day and close it here or somewhere here, right? If it closes here, I can say that the pattern, the downtrend is continuing. Next day could also be opening downwards. If it closes somewhere here around middle, then we can say that the pattern is reversing. It's a continuation. The prices are getting consolidated here. So that's why we have to look at the opening and closing prices as well, along with the short-term patterns. So now let's start looking at the patterns, actual patterns in terms of short-term patterns. Now, one of the first short-term patterns that we're going to see is gaps. What is a gap? You'll see this is an area where no trade has happened. So if you notice this particular chart, these are day bars. After this particular bar, the trade happened in this particular range, but next day the trade opened directly below at a price much lower than the previous close. So no trade happened between this region, right? So that's a gap, and that's a simple form of gap. Now gaps themselves have no meaning unless they are seen in a context, and they're usually indicating there are different types of gaps, and they have the context. We have to look at them in terms of context. Only when we can have some meaning in them. Now, most profitable gaps are those that occur at the beginning of the trend, also called as a breakaway or breakout gap, right? Breakaway gap or breakout gap. Now, these gaps happen before prices suddenly break through a formation boundary and major change in trend direction begins. So there is a major change, and breakaway gaps signal, these kind of gaps signal that one pattern is completed and boundary is penetrated. So in case of previous example, let's say cup and saucer, we could have a gap somewhere near the handle, and that would suggest that the handle has reversed. So gap themselves are not very meaningful unless they are part of some trend or a pattern where they would suggest a reversal or breakout of that particular gap, particular pattern through a gap. Size of the gap, that is basically indicative of the intensity or strength of that breakout. So heavier the volume and longer the gap, larger the gap, the more strength within the subsequent price movements. Now these gaps may fill immediately or they might continue. So for example, in this particular zone, this gap is not filled, it's continuing. The prices were decreasing, and even after the gap, the prices are continuing to decrease. A reversal or a filling of gap or stop and reverse would be if, let's say, the price open here, but next day's trade moved up and it covered up this gap. Right, so the trend is not being continued, but it's reversed. So it was just a random gap that formed for some reason, but it's not really a indicative of anything happening. Another gap that is very beneficial or something very profitable on its own is explosive gap pivot or expansion gap pivot. Now this is, again, there is a gap, it's an upward gap, but there's also this pivot point. Now you would notice, if you follow these three dotted lines, there is this breakaway gap, right? The prices have moved up, but then it is also partially filled up, right? The reversal has happened. Price moved up, the gap formed on the upward direction, but didn't continue in the same direction. It actually moved down in a direction to fill out this gap. So this is next 2 days, 3 days, we see that the price is going down to fill up this gap, but it has not reached the bottom, right? It has not reached this dotted line, which was my previous trading price, but it has reversed before that. That's my pivot point where the prices have pivoted upwards. These two prices which reached this dotted line, these could act as my protective stop. So if I'm entering here, right, let's say I see this gap, I expect an uptrend, so I could enter into a position here and put this as my protective stop, so that if this gap if this uptrend, if this explosive gap up is not a true trend, right? It's not a true uptrend, and the prices are reversing, the gap is getting filled, then my losses are covered. I will be in loss, but my loss would be limited. On the other hand, if I'm entering in this region after, or rather in this bar rather, right, when the pivot point has already passed, then again this could be my new protective stop, wherein if prices drop below this point, then there's a chance that the downturn will continue, and I will use that as my new protective stop. Now if you notice, all these bars are just simply straight view lines. What it means is the opening and closing points are not material. Opening could be here or here, closing could be anywhere on this bar length, but that does not have any impact on the interpretation of these gaps. So that's why we are not adding the opening and closing lines here to confuse interpretation, because they are not material. What matters is the length of the bar, the distance between high and low points of the bar, point prices during the day or hour over which the bar is formed. Another type of gap which is very common or very closely monitored is the opening gap. Now, as the name would suggest, this gap is formed during the opening period of the trade. We know the opening period is very volatile, and it's more of a price discovery, where we might see prices moving erratically, either up or down. So opening gap is really interesting price points to follow. If that opening gap is reversed, for example here, if this was an opening gap for the day, we have to monitor first 2-3 minutes of price data, and because these are short term prices, so we have to actively, instead of daily prices, we can have hourly prices, hourly bars, or even minute bars. Now if next 3-4-5 trades are closing in this gap, then the reversal has happened, and there is the gap is reversed. There's no trend over there. But if that gap is not reversed, if the direction continues, then we can see that this is the direction, this is the trend that has been that is going to be followed, and then we can enter into trade accordingly, right? Whether the gap is downwards or upwards, depending upon with how the opening gap is being formed. So that is something that we have to keep in mind. Again, it can happen that the gap gets filled up after our observation window, while we have after we have entered into a trade, but that is a risk, and that is one of the risks that opening traders or trading in the opening period, opening window, have to take. Now another type of gap is a runaway gap or measuring gaps. So these gaps occur along the trend. So there is an uptrend, and let me just draw here. So if there is an uptrend, it's continuing, a runaway gap or a measuring gap could be along this trend direction, right? For example, after this bar, there's a gap here, next days or next hourly trade happens this price, and uptrend continues to happen after that. It's not getting filled, so it's a part of my longer trend. That's my runaway gap. Exhaustion gap could be somewhere near the top. So in this case, another type of gap, in this case we see this gap, but it gets reversed, right? Here the volume is reducing, the strength of the gap is getting the strength of the trend, longer trend, is reducing. So after this gap, we might see there's a sudden reversal, and the gap is not only filled, but the trend is reversed. So it's more like an apex of my trend, the highest point of my trend. So this could be my exhaustion gap. So if trend continues, both these gaps are found as a part of a trend. If trend continues, it would be called a runaway gap. If trend reverses, and that's as an apex, that would be an exhaustion gap. Now it could, whatever we have said for uptrend is very well applicable for a downtrend. So it's the same observation, the same explanation, but we'll not spend time on working on it again. Another minor gap, which is not really profitable or something we can do about it, is the ex dividend gap, right? Ex dividend gap, as the name suggests, it is observed when the shares go ex dividend price. So usually found on a daily bar, daily price bars. Another type of gap is suspension gap. In terms of volatile markets, there could be trading halts. So after the trading halts, the price could move at a really different region, and that could create a gap between prices. Or it could be simply because of end of day trading. Trading ends at 3:30 for the day and opens again at 9 o'clock. That's part of my opening gap as well. So these are small gaps. You just need to know, like, good to know material. Not much that can be profited from these gaps, right? Unless they are part of the other longer trend.